All right, good afternoon. Welcome back here to Trader Minute. Great to have you aboard. Market opened up fairly flat after reversing a 60-point loss on the absolute monstrous jobless claims number, and rallied, took away the loss, and then has rallied up about 100 points here, 110, somewhere in that area where it sits right now. And, typically it would be, hey, there's a monster day. But in this market, with the movement we've had, it's very much in line with a lot of the percentage retracements, moves, and things. I'll go out, we'll take a look at that here. As you see on my screen, I do have the John Hopkins Coronavirus Resource Center stuff. We continue to see the virus outbreak growing exponentially when it comes to around the world. When we look at Italy and we look at the growth here, it continues to be pretty strong. U.S. growth, same, still in those exponential phases. China has been flat now for a long time, and there is a lot of hope that the exponential phase in the U.S. and Italy basically turns into what China has been over the last month. Now, there's a lot of, debate about whether these China cases are really real, and, whether it's being tracked properly or we're getting the full story and all of that. And, to each their own there. But, we see Spain, taking off exponentially, Germany exponentially, Iran continues to see, big growth there in cases, France. So outside of China, the UK, the growth of corona cases is increasing exponentially still. Now, one other area that's a little bit different is South Korea, and this is one that gives investors, traders hope that hey, okay, maybe this will be the course after the big exponential growth. Maybe it'll just flatten out. Maybe China isn't just maybe China, what's going on there is a little more indicative of what's going to happen elsewhere. But we are seeing some of that hope come in and some of that bounce come in here with it, to go along with the gobs and gobs of money that have been thrown at the market. But let's face it, market is not rallying because of the gobs and gobs and gobs of money that have been thrown at it. We started to see money thrown at the market way before, the market bottomed. We saw money thrown at the market by China right back here at the end of February. They threw more in March, the European Union in March, U.S. Fed in March, early March, and the market continued to go down, even with all those, gobs of money being thrown at it. Now, we have seen, even more now get thrown at it, and it does correlate to a bounce. So, naturally, people are concluding, well, you throw money at it, most stocks are going to go up. Well, then why didn't that work back here? To each their own opinion with that, but, you probably know where I stand here with that. But, for me and for looking at kind of what's going on, we're looking at a very nice relief bounce, to be sure, and one that kind of has this hope that maybe the coronavirus pattern around the world is a similar pattern to what we are seeing play out in South Korea. So far, too early to say. Italy is still growing exponentially. But, there is that hope there. And if those hopes get dashed, we will see another big dose of selling, in the market. And if those hopes get, confirmed, well, we've already talked about it. The market could be in for an absolute straight-up meteoric rise to new highs and then some. So it's one that, anyway, that's, what's going on there. And I know there are millions of different opinions and everything else out there. But as I look at it, as I kind of, consume and watch and, observe the various, aspects here, this is kind of what I'm looking at. I've mentioned before that the economic data doesn't matter for the next several months, the economic data is worthless. We know it's going to be ugly. We know it's going to be bad. That's why the market sold off, right? This isn't something where the market has to wake up this morning and go, oh, wow, jobless claims were terrible. Wow, where did that come from? No, that's not what this market is. This market understands that the numbers are going a super ugly number and the market rallying. And I think what that does is speaks volumes to the. I'll take a look at the challenge and take a look at this idea that I mentioned yesterday that I was looking for a put spread on the market, and I still don't have one. And I'll show you what I'm looking for and kind of what's going on here with that. Why I'd be looking at that, and in the in that process, kind of show you what the Fibonacci's that I'm looking at here with it. But let's start with the challenge. We have quite a few 3-7 upside crossovers. They're all like yesterday. In fact, some of them are the same stocks that were on this list yesterday that sold off into the close. But they're all in that same basket, coming off of a brand new low. So not going to get a trigger here on them. Now, I've mentioned that if the market vibe turns bullish, I will go out and look for a SPY call option to play it with. The reality, though, right now, the market vibe is neutral. Now, it's still too early for its final measurement of the day, but it has moved to neutral. Now, neutral does not mean next stop is bullish. I know there tends to be this idea that it goes from bearish to neutral to bullish, or bullish to neutral to bearish. That's not normal. In fact, most of the times when it goes from bearish to neutral, it drops back into bearish more than it goes up into bullish. So it's one where neutral means neutral. It doesn't mean what's coming next is, bullish or bearish. Neutral is neutral. Now, what does neutral mean? Well, neutral means that the volatility is going to start to contract. That we're going to see there's still going to be some chop, but we may not see the market go anywhere for a while. We'll have a big up day or we'll have a big down day, but ultimately probably not going to go too far one way or the other. Now, that could change if we see it go bullish or change if we see it go bearish, but that's the neutral reading. So I'm not going to buy a call option on the SPY in that with that reading here on it, given what the option pricing is here for them, because the option pricing continues to be pretty insane. And insane probably is just not a good enough word, but pretty ridiculous in so many ways. But the right pricing for what the market is right now. Okay, all right. So no trade for the challenge. I'm as anxious as anyone to let's go. Let's get jumping in there. But as I mentioned when this whole thing started, I will be patient and I will not jump in until I have a signal. And, while, yes, we are seeing 3-7 crossovers, the reality is they're still coming off of lows, the Honeywells of the world and things like that. And, chasing these things just doesn't pay off when we look at things historically. We had similar action back here on Honeywell and many of the challenge stocks. When we saw this price action in early March, we saw the relief bounce, and that was a very nice bounce, very big bounce, and we had a lot of 3-7 crossovers there, but they did not qualify as signals, and had they, would have ended up with some pretty big losses. So, not qualifying as signals right here, but, do set the stage or, start to put in some of the groundwork that we need for signals going forward when a lot of this is done. All right. Okay, now last thing here, the SPY, and I mentioned yesterday, I'm looking at this bounce, and I'm looking for an opportunity to buy a put spread. Not because I think, the market's just going to collapse from here or have any real insight that I go, man, this is just mortgage the house, let's go, put it all in, go. No, this is something where I look at and I say, okay, if we look at normal patterns, The initial bounces, they tend to get sold into at least down to the 7-day moving average, if not a little bit further. Can I take advantage of that? Well, first thing I do is I go and I look at the option values. And the hard part right now, and the thing that I ran into yesterday, is looking at the option values. There simply wasn't a good risk reward for me to jump into. Now, they have improved today. They have improved, significantly today, but they're not where I go, man, I can pay 10 cents and get potential, dollar reward. It's more like I got to pay 30 to 35 cents and get a dollar reward, which is more going to look like an 80 to 90 cent reward. So it's not as not as alluring as it might be in other situations, but it's getting a little bit better. It is improving just a little bit here on the day. But one of the reasons that I've held off just comes down to understanding the nature of bounces and how bounces tend to go. And I do have some upside exposure. We've talked about some of those things that I've bought, during the down, and some of them like Royal Caribbean and Boeing and Bank of America. They continue to bounce, and I'm rooting for them to continue to bounce. But as far as for a SPY put trade, this is something where I don't really care about what other positions I have on the board. It is something where I look at it and say, if I can get good value for really strong reward potential, I'm willing to make this trade. It's the same thing I did right back here, and I showed it on video where I bought the put spread, and I know the market went down the next day, then rallied big the next day, but ultimately paid off phenomenally well. And it's the same concept. It's not a different concept, but the pricing's a little bit different. Don't have as good a reward potential right here. But if we go and we look at these pullbacks and these bounces, right, and I'm going to come in and put some extra bars here on this chart. You'll notice I don't have any indicators. I don't really care about my indicators right here. This isn't a MACD thing. This isn't an RSI or an MFI or any technical indicator thing. This is just kind of knowing or understanding basic patterns that we see from the market. And I like to apply these things to the market. I do not like to apply these things to individual stocks. Individual stocks over the last 10 years have shown that they kind of have their own, they beat to their own drum. When it comes to the overall market, these things are a little bit more effective. But here we have the initial drop. The initial drop in the market, and then the initial rebound. And you'll notice the initial rebound recovered 50% of the losses. That's a normal kind of retracement area, for this to happen. Now, I didn't wait till it went up to 50%. I ended up getting in here when it was only 40% retracement, knowing that, it could still go up and kind of get into this full retracement area anywhere between 38 and 62%. But this is the area where I tend to like to say, okay, we've now had a nice bounce. Where can I set some downside exposure at? And that's what I used. I didn't get overly aggressive or anything like that. And, just put on a put spread that said, hey, you know what? If we do go back to the lows, it's going to pay off very, very nicely. And it did, which, okay, great, fine. But what about now? Well, if we apply this same Fibonacci, looks a little different, doesn't it? I know we've had a monster rally in the market over the last 3 days, but it still is not even a 38% retracement of the losses. That's pretty mind-boggling in many ways. But when we look at normal bounces, it still hasn't come into the realm of normality here with it. Now, we can apply something a little bit different here as well. We can apply a Fibonacci fan. Now, what's a Fibonacci fan? Well, a Fibonacci fan, and let me do this here for the initial drop. So we had the initial drop, And the Fibonacci fan, what it does is kind of brings in a little bit of a time period to say, well, yeah, we have our retracement levels. The longer the rally goes, the bigger the rally will likely be. And so we're looking and saying, okay, initial bounce, we come into the first fib area, we come into the second fib area on day 2, and that's where I ended up buying my put spread. On the initial drops, the fans, they tend to happen. The bounces tend to be quick. It's a 1-2 day thing, and then, drop back off, that type of a thing. But as we go longer, and as we measure this pullback to a much greater degree, you'll notice our fans spread on out. Today is the first day where we have come and hit. Well, yesterday we came and hit it, but today we're breaking it, the first fan area. Now, what is that? Well, that is the expected bounce area over a certain period of time. So, the quicker it bounces, the stronger the bounce tends to be. The slower it bounces, the lower the bounce tends to be. And this kind of gets read in the same way as Fibonacci retracement in terms of, well, somewhere in this fan area is what I can expect when it comes to the bounce. So I look at what's gone on, and I look at what's happened, and I say, okay, we're coming into that area now. And yes, I don't have great value on the options, so I don't have to be, too eager to get in. This isn't like a trade where, I can put 10 cents in and make 800% on my money. This is just not that case, so I tend to be a lot more patient in these scenarios. But I know that here over the course of time, tomorrow, see 265 is possible, and the next day to come up to the full arc up here to 280 or the full fan to 280 is potential. And that could happen in 2 days. I know, last week we could say, no way it gets up to that first fan area. That's ridiculous. Well, it has. And to see it get up to that third fan area here in 2 days, it could do that. So I know my risk factor is up here to about 280 there with it. Am I comfortable with that risk factor? Well, if my option were 10 cents, yeah, I would be. I'd be more than happy to do it because I know I'm not going to lose too much, and I know that if it makes this move, I can buy another one for 10 cents and be good to go. So my net exposure there, 20 cents, great. Well, now it's going to cost me about 30 cents right now, and in 2 days, it's probably going to be another 30 cents. So I'm putting out 60 cents to possibly, make 9. It just doesn't make a lot of sense. So I've been more patient and saying, okay, I either need to see better pricing or I need to see some sort of, push up into these further fans, or I need to see some sort of topping element come into play. And I haven't seen any of it, right? I haven't seen any of it. So I continue to be patient, continue to kind of wait it out and say, all right, we'll see when it happens. I'm not in the business of predicting if it's going to happen or, if it's going to hit this one or it's this chance of hitting this one or this chance of hitting that one. I know those are probabilities. Now I have to say, with knowing that, what do I want my exposure to be? And so far, my exposure to the downside is 0. I don't have it. I just don't have it, and I don't have a reason to grab it here just yet. Doesn't mean the market doesn't tank tomorrow. It could tank, and I know, someone will say, hey, you know what? Well, man, too bad didn't get the put spread yesterday. And I'll say, no, because yesterday it didn't make a lot of sense. It didn't make a sense from pricing, risk, reward, and from what I've shown here. And these are what I tend to use. These are what I tend to look at. It's very simple, very easy. It's not something with a lot of interpretation. And when I get what I want to see, then I go for it. Am I willing to buy a put spread for 30 cents that has reward of $1 when we're at the full retracement fan? Yeah, I am. But I'm not willing to take that risk reward when we're only at the first one. Just simply because I know if we get here, the odds are significantly greater in my favor than they are down here. Alrighty. So anyway, hopefully that helps in kind of gauge that. Again, I don't use this for individual stocks. I don't find much value with individual stocks. And if you kind of take individual stocks right now, for instance, a Boeing, and try to apply this, there's just not a great application here on it. In fact, I'll put the fan on here. And one of the things and one of the drawbacks of a fan is you can see how different it looks depending on which candle I lined it up with, right? The fan's going to look a lot different. So I try to use the top, for the fan, but, it's just not nearly as good with individual stocks. But you'll notice that almost all of the stocks that have rallied here over the last several days have moved into this first fan area, and it's a big rally. And, some of those stocks that fell less haven't rallied as much, but they're still in that first fan area. Where some of the stocks that have fallen the most, well, they've rallied the most, and they're right into that first fan area. So on a percentage basis, if we look at absolute gain and loss, the ratios are off from stock to stock. When we look at it from a percentage basis, most stocks have moved in the same relative area, considering what the pullback for that stock was. So hopefully that helps there a little bit. Now, if we do see a challenge signal or the market vibe does turn bullish by the end of the day, I will jump on at the normal time. If it doesn't, I won't jump back on. But, if it does, I will absolutely jump on and go. But looking at the scan results so far and running the algorithm, it's blank. So I don't expect anything. But, some things could change. We'll see, how it plays out. I think one of the closer things is a Netflix to possibly triggering. But it does need to have that downside crossover first before getting an upside crossover there. But, I do think there's a good potential that a lot of the V-shaped rebounds that we've seen, or a lot of the big sharp rebounds we've seen, go the way of Netflix here over the next several days, where, just kind of flatten out, find a little base, lower volume, and ultimately that would be very bullish. Now, if we continue to see the Corona numbers erode, the technicals and the tendencies simply aren't going to matter. The panic will return, and the panic will be, the key short-term driver there. Thanks for hopping on. Have yourselves a great one, and we'll talk to you later. Take care.